Wealth Live. My name is Matt Sorensen. I am excited for today's topic. We're going to be talking about the backdoor Roth IRA. I know it sounds a little salacious, but it is. It's pretty sexy, actually, for your retirement account, though. Okay, this is for your retirement and planning for your future. The backdoor Roth IRA is the #1 strategy in retirement accounts for high-income individuals. How are the rich putting money in Roth IRAs? How are people maxing out 401ks, putting money in Roth IRAs and retirement accounts? I'm going to talk about that in today's live. I also want to give you an update here. This is critical breaking news over the last couple of weeks. The Biden administration has put out policy indicating they want to close out the backdoor Roth IRA. They think it's too good. They think the government isn't collecting enough taxes from people who are wealthy. So they want to close out this loophole called the backdoor Roth IRA. So we're going to be covering it today. I want to make sure you understand what it is, how to utilize it, and how the steps need to be taken in the particular format we're going to go through today. Now, as you have questions, please ask them. We're on multiple platforms going live right now. We're going to be fielding your live questions. I also have 15 or so questions already came in that we have from on the topic already. So I'll be addressing the questions already in the queue right now. But let me explain what this is and why it matters. The backdoor Roth IRA is a Roth account where you can put money in. You can grow it on any investments, pay no tax on the investment gains, and it comes out totally tax-free in retirement once you hit age 59 and a half. That's what a Roth IRA is in general, a Roth 401k. A lot of people are familiar with that. The backdoor is just the way you get to the Roth IRA. It's nothing different. It's just a process on how you get it and set it up. Frankly, it is a loophole in the tax code, and I'm going to talk about how you exploit the loophole because we want to use this, right? We want to utilize what's in the tax code that can benefit us, okay? So the backdoor Roth, at the end of the day, it's just a Roth IRA. You can put $7K a year in it, pay no tax as the investments grow, and it comes out totally tax-free. Now, the difference of a backdoor Roth IRA than just a regular Roth IRA is the backdoor Roth IRA is for people who cannot do a Roth IRA ordinarily. There's two groups of people who are excluded from going in the front door to set up a Roth IRA. Those two groups are high income earners, and a high income earner, by the way, is someone who makes 146K or more. This is your modified adjusted gross income, 146K a year or more single, or 230K or more a year married filing joint. If you're over that income level, you can't do a Roth IRA. You phase out. In other words, the government said, we don't want to let this tax-free tool be used to people who make that much money. So the Roth IRA, you cannot go in the front door. That's the first group of people who need to use the backdoor Roth. And again, I'm going to explain the loophole here and how you get to the backdoor Roth IRA. So for any of you who are like, man, I've always wanted to do a Roth IRA, I make too much money, this is for you. This is what this is. This is exactly for you. I use the backdoor Roth IRA and have for years. It's how the only way I can do a Roth IRA. And I've had thousands of clients use it as well. Okay, now the second group of people who cannot do a regular Roth IRA, people who max out their 401k. People who max out their 401k, well, how do I get more money in retirement accounts? I don't want to put more money in my company 401k. I can only buy mutual funds or target date funds I'm not excited about. I'd rather have more control to do real estate or self-directing or private companies or frankly, day trade stock. I'd rather just have more control of it than my company 401k. But I've already maxed that out. What more can I do? You can do the backdoor Roth IRA also, okay? So those two groups of people, high income earners and people who already max out a company 401k plan, the backdoor Roth IRA is for you. This is how you get into the Roth party. Like this is your ticket to the Roth party, tax-free growth, tax-free returns on the way out in retirement. There's no other way to make money on investments and grow wealth tax-free than a Roth IRA. Traditionally excluded for high income people, excluded from people who max out their 401k. The backdoor Roth IRA is the loophole. And like I said, President Biden in his last budget that just came out 2 or 3 weeks ago indicated they want to close the backdoor Roth IRA and the mega backdoor 401k, which is just the backdoor 401k. We'll talk about that on another live. But today I'm going to focus on the most popular, the most utilized strategy, the backdoor Roth IRA. All right. Now here's how it works. It is a 2-step process on how you do a backdoor Roth IRA. First, you need a traditional IRA. Now, I know everybody's like, wait, Matt, we're doing a Roth IRA. Why are we doing a traditional IRA? Hang with me here, okay? We're going to do a traditional IRA because you do a non-deductible contribution to the traditional account, meaning I don't take a deduction. See, Roth IRAs and traditional IRAs are very different. In a traditional IRA, you put your money in and you get a deduction. If I drop $7,000 in for 2024 into a traditional IRA, I get to take a $7,000 deduction on my tax return. In a Roth account, though, when I put $7,000 in a Roth IRA, I don't get a tax deduction. But the government said, no tax deduction now, but as it grows, it'll also come out tax-free. In the traditional account, you get a tax deduction on the front. When it grows, there's no taxes as you're growing the wealth in the traditional account. But when you pull it out later in retirement, you pay tax on the money when you draw it out. So if you draw $100,000 out of your traditional IRA in retirement one year, you're going to pay tax on $100K of income. If you pull $100K out of your Roth IRA in retirement, there's no tax, period. So those are the two differences on a traditional and Roth. But we have to get a traditional IRA to do the backdoor Roth. Now, when I put the money in the traditional, we're going to do what's called a non-deductible contribution. If you go to your IRA custodian, whether it's us at Directed IRA, Fidelity, any other company, your local bank or credit union, you're like, I want to make a non-deductible contribution to my traditional IRA. They're not going to know what the heck you're talking about. Maybe they will, it's possible, but for the most part, they're not, because they don't do anything differently. They're just going to take your $7,000 and say, oh, it's within the contribution limits. The way it becomes non-deductible is on your personal 1040. You indicate on your personal 1040 on your tax return that this was a non-deductible contribution, okay? All right, now that's step one. I open up a traditional IRA and I make this non-deductible contribution. If you want to do this right now and you've never heard of this and you're like, Matt, I want to do this right now, here's what you could do. You could do 2 years of contributions. Because it's before April 15th, we can still make 2023 contributions, which is $6,500. Then you can make your 2024 contribution of $7,000. So you can have $13,500 into a traditional non-deductible IRA. That's step one. Now, step two is we're going to open a Roth account. You do need a Roth IRA account to pull this off. So we're going to open up a Roth account, but there's nothing in it. You're not contributing anything to the Roth IRA. Why? Because you make too much money or you've maxed out a 401k. You don't qualify to make a regular Roth contribution, but you can have a Roth account and you can convert that $7,000, $6,500, $13,500, whatever you put in that new contributions there, as I was just talking about, you can convert that over now to the Roth IRA. So now I opened up the traditional, I put in the non-deductible, and let's just say I did 1 year for 2024, $7,000. I open up the Roth account, step two. Step three, I convert the traditional non-deductible dollars over to Roth dollars. Now, usually when you do a Roth conversion, there's tax on it, right? If I have traditional IRA dollars, like $50,000 in traditional IRA dollars, and I want to convert that to Roth, the government will let you, but you got to pay tax on the value of what you convert. So if I converted 50K of traditional dollars to 50K of Roth dollars, you have to take 50K into income that year. You'll get a 1099 from your IRA provider, Directed, Fidelity, whoever that is, and you're going to pay tax on that. However, in the backdoor Roth, that $7,000 we put in as a non-deductible contribution, we did not take a tax deduction. So when you convert non-deductible dollars, that $7K over to Roth, there's no tax on the conversion, okay? Now, this all happens on your personal 1040. As far as your IRA custodian is concerned, you've opened up a traditional account, you've opened up a Roth account, you put money in your traditional, you converted it over to Roth. Now, it's a little more complicated than that because you do need to get it right on your 1040 on your tax return. You're going to fill out Form 8606. This is an additional document that goes on your 1040. It's kind of like the schedule with your 1040. You have to do it when you do any retirement account distributions or Roth conversions or things like that. It's a very common form. It's not complex. It's in all the tax softwares if you're self-preparing your return. But you fill out that return and you'll indicate that that money you put in the traditional was non-deductible. It was converted to Roth, no tax on the Roth, and now you've booked in the Roth conversion. That is the loophole. That's how you get around not being able to make a regular $7,000 Roth contribution right into the Roth IRA. We have to go through these loopholes, and sometimes it's a pain in the butt, and that's how the tax code works because we got to thread the rope. I was going to say thread the needle. I mean, we're kind of doing the needle. I don't know. You got to go through the steps, is what I'm saying. To really execute the loophole properly, it's technical. Frankly, it's kind of something that wasn't thought through well in the tax code, and so we want to exploit it. We want to use it to our advantage. So we are going to take that two-step process. It's non-deductible, convert it over to Roth. All right, now, Tristan, you let me know if you had a question. I don't know if you had something for me.
All right. We did get a question from YouTube. They're asking, hi, Matt. I have a partnership LLC, part Roth, part traditional. Want to gradually convert to 100% Roth. Can this be done? And does the operating agreement have to be updated?
Okay, yes. Now, this is for anyone self-directing, and we'll come back to this. A little off topic on the backdoor Roth, but it is Roth. So we're going to Roth and roll and take that question. So if you have an LLC, and this is, by the way, people who self-direct, we do it every day at Directed IRA. People have Roth IRAs, traditional IRAs, and they're invested in LLCs and private companies and rental properties, private lending, private equity. These are all assets an IRA can own, and that's what we specialize at our company, Directed IRA. Now, what the question here is, they have an LLC that they have traditional IRA dollars and Roth IRA dollars invested in the same LLC. The LLC owns some asset. Let's say it's a piece of real estate. If they want to convert and get rid of the traditional over to Roth, that's possible. You have to get a valuation for the LLC, determine what it's worth. So we got to know what the property's worth, what money's in the checking account, and that sets the value of the LLC. Let's say it's a $200,000 LLC, 50% Roth, 50% traditional. You can convert that traditional over to Roth. Now, you would need to update the operating agreement and work with your IRA custodian to make the Roth conversion election. But you could you could do it in steps too, but that is possible. Yes, absolutely, you could do that. And by the way, we will be doing more open forum Q&A for perfect topics like this. We also have our Directed IRA podcast where you have all your self-directed questions like this. But good question. You don't need a backdoor Roth to do that. That's just a regular Roth conversion though. Okay, so let's summarize the backdoor Roth IRA. I want to make sure everybody got that. I got a little sidetracked on that question there. But let's just make sure everybody understands the backdoor Roth IRA. You put money in a traditional account. You're going to convert it. That $7K, that's your annual contribution, over to Roth. Now you've got $7K in a Roth. Now you're investing from the Roth. Now, one of the rules that you need to know is what's called the 5-year rule. There's something in Roth accounts that applies to Roth conversions called the 5-year rule that says when you convert money over to Roth, which is what you're doing in a backdoor Roth, there's a Roth conversion happening there. And that $7K that's now in the Roth IRA, that's from a Roth conversion. So you have to wait 5 years before you can pull that money out tax-free. So I want to make sure everyone understands that, particularly people in their later 50s where they're like, well, Matt, I opened this when I was 58 and now I'm 62 and I want to pull the money out. Well, you can't do that yet. I know you're over 59 and a half and you think there's no penalties for starting to withdraw money from your Roth tax-free, but you have to satisfy the 5-year rule. And that is every year you do a backdoor Roth, there's a new 5-year rule every year for each one of those conversions. So over time, eventually it's not going to matter. You'll build up the Roth, but just know you're going to need to wait 5 years before you can pull that money back out totally tax-free, even if you're 59 and a half. Okay, so now here's one of the roadblocks to the backdoor Roth. This is one of the common mistakes or the common issues that you're going to face in doing a backdoor Roth IRA. When you convert non-deductible traditional dollars to Roth dollars, that's step 3 there in the backdoor Roth conversion process. That's the conversion itself. You have to also convert deductible traditional dollars. So if you already have a traditional IRA with money in it, it's almost always going to be deductible regular money. You took a tax deduction when you put it in, or maybe it was an old employer 401k you rolled out to a traditional IRA. Maybe it's a SEP IRA, you're self-employed. Those are all traditional deductible dollars. If you have any of those, you need to convert those before you can do a backdoor Roth. Now, if you think about it, I know a lot of people are like, man, Matt, that sucks. I want to just keep that money going and doing what it's doing. I want to get more money in, but I want to do Roth. I know it's a bummer. You have to convert that first. Technically, you can do what's called a pro rata conversion, where you convert a portion of those deductible dollars and a portion of the non-deductible dollars. But I think it's really messy. I've never seen anyone go for it. As a rule of thumb, we typically say convert your regular traditional deductible IRA dollars before you do the backdoor Roth. Now, if you're like, well, Matt, I have a 401k with traditional dollars, a solo 401k with traditional dollars, that's totally fine. To do the backdoor Roth IRA, we just have to convert IRA dollars to traditional first. So any of your traditional IRA dollars will need to get converted first. So if you're like, well, Matt, I got a $100,000 traditional IRA at TD Ameritrade, I want to do the backdoor Roth. we're going to have to convert that traditional IRA at TD Ameritrade first. Then we can do the backdoor Roth. Now, I know it sucks, but just if you can get over the conversion, pay the tax, moving forward, that account, that whole 100K is now growing totally tax-free, plus all the new money you're going to be able to put by doing the backdoor Roth every year. We are definitely Roth fans. That's the number one account type we have at Directed IRA is Roth accounts. The reason for that is 2 words, tax-free. Tax-free, you get to make money tax-free in a Roth account. Don't pay any taxes, you're growing it, and it comes out at retirement totally tax-free. That's the beauty of the backdoor Roth IRA. All right, now let me hit some questions that came in. This question came in from James. Do I understand correctly that any existing traditional account you have in your name held at all institutions would have to be converted prior to the initiation of a backdoor strategy? Is this why many people would choose doing a mega approach before the backdoor? Yes and no. So, yes, you do have to convert any of those traditional IRA dollars at any institution. Those are all going to come into play before you can do the backdoor Roth IRA. The mega backdoor Roth, by the way, is a strategy you can do in a 401k where essentially you do an after-tax employee contribution and you convert it to Roth. We're going to hit that on an upcoming live. But that's another approach to get more Roth dollars. If you have a 401k, whether it's solo or a 401k at a day job, most of them allow for after-tax contributions that can be converted and rolled out to Roth as well. So that's another opportunity there, is the mega 401k. All right, Tristan.
All right, we got a question from YouTube. Hey, Matt, did you say if someone maxed out their 401k, then they can't do the backdoor Roth IRA? So if it's only traditional dollars that you can max out both your 401k and IRA?
So if you're maxing out your 401k, you're going to have restrictions on making a traditional deductible contribution or a Roth contribution, because if you're typically maxing out the 401k, you're over the income limits in Roth. So you're going to do, but you can do the backdoor Roth. So max out the day job 401k or your solo 401k even, and do the backdoor Roth IRA on top of it. So absolutely available to anyone maxing out their 401k, whether it's your solo case, self-employed, or your corporate America 401k at your day job. All right. Kay Jones asked, I heard something about doing a backdoor Roth from traditional to Roth, that money can't be used for 5 years from the time of the conversion. So yes, just be careful on what you say money used. So that was the 5-year rule I talked about. When you convert that money, you've put that $7,000 in, let's say if it's a contribution, non-deductible, you convert it to Roth, you can invest it immediately. That money can be used and invested, and it's growing. You're not paying taxes on it. The rule is you can't take the money out in retirement. So if you hit 59 and a half, and again, let's say you're 58 and you just put in $7,000 and now you're like, well, I'm 60. Well, you've got 3 years to wait on that 5,000 you put when you were 58. So there's a 5-year rule. It only really applies to people in their later 50s that are looking to pull it out quickly, frankly, because you have the 59 and a half age requirement anyways before you pull it out penalty free. But you can definitely use the money and invest it. You just can't pull it out for personal use and take a distribution until after 5 years has passed. Istvan asked, is there any age limitations for the backdoor Roth IRA? I'm 70 years old. No, there is not. There used to be, but there is not anymore. This was changed in Secure 2.0. You can have a Roth IRA at any age, even the backdoor Roth, which requires a traditional contribution. There used to be limitations on that as well, but you can contribute at any age. Again, it's non-deductible, converted over to Roth. So you could do the backdoor Roth at any age. Now you do have to have earned income though, and that doesn't, and Social Security doesn't count, investment income doesn't count, rental income doesn't count. You have to actually have earned income. So I presume at 70 years old, you're still working, but you could still do the backdoor Roth even at age 70. All right, Blooming Y asked, my husband did a backdoor conversion early 2022 while no existing traditional IRA balance. Okay, so that was good. And later in the year, my husband had a company contribution into a SEP account that wasn't expected. Is that okay since we didn't have any money in the traditional IRA at the time of the conversion, or is that an issue? How can we fix it? You're totally fine. Don't worry. It's at the time you make the Roth conversion, did you have any traditional dollars? So if there was at the time you made that back to that non-deductible contribution, converted it to Roth in 2022, that would have been 6,500 or 6,000. You only have to look at that moment in time. If later in the same tax year, a new traditional contribution comes in that's SEP dollars or just regular traditional dollars, don't worry about it. That's not going to be an issue. We only look at the time of the conversion. All right. James has a question. Just seeing if we had any live questions here. Live people get questions earlier. Okay, I'm going to take your questions here about 5 minutes about non-topical backdoor Roth IRA. Okay, we'll do a little open forum, rapid fire Q&A. For any of you that are hanging out that don't have a backdoor Roth question, we'll get to those second. Let me get through some of the backdoor ones particular though. So, all right, this is from Randy Birdie. He asked, questions on the Roth. Understand to convert my traditional balance to Roth, I need to pay tax during the conversion. Do I need to do that before I'm allowed to do the non-deductible Roth contributions? Okay. Yes, when you convert, you will pay tax. Now, you don't pay it immediately. So let's say you had a 50,000 traditional IRA like right now, and you're like, Matt, I want to do the backdoor Roth. I want to put in $6,500 for 2023 because it's not April 15th yet. I can throw the $6,500 in as a non-deductible contribution. I want to do 7,000 for 2024. So I got 13,500 there. But I have 50,000 in a traditional IRA and I want to convert it first. Cool. We can convert it first, convert that 50K to Roth. Now you'll pay tax, but not until April 15th of next year because it's going on your 2024 tax return. If we're talking about you doing this like right now, next week you did this, that's going to go on your 2024 return. You're going to get a 1099 from your IRA provider, wherever that $50,000 traditional IRA was at. And that'll come to you in January of 2024. You put it on your 2024 tax return. Now, you could pay in the tax now if you wanted, or you can worry about it and deal with it later on your tax return, April 15th of 2025.
I got one from Instagram.
Yes.
Should I backdoor new contributions into my existing Roth IRA or keep them in my Roth solo 401k?
Okay, great question. If you have a Roth solo 401k, I would put all your money in there first. Once you've maxed that out, which you can do $69,000 a year in the solo K, there's different ways that gets calculated, but you basically put 23K in as employee contributions as long as you made 23K in the business, and that's Roth dollars you could do. The rest is from matching or after-tax contributions that you could do to Roth. After you've done that, I would come and do the backdoor Roth IRA, but I would max out the Roth 401k first, the solo K. Okay, this is a great question. Why does Congress limit the IRA's max investment of $6,500 under age 50, $7,500 over age 50, not including backdoor? So the amount you can put into a traditional or Roth account is always set by Congress. It's $6,500 for 2023, which again, you can still make up until April 15th, 2024. No extension though. Even if you extend your tax return, that doesn't buy you more time. You've got to have it done by April 15th, even if you extend your return. So if you want to get in 2023 contributions, a lot of people are throwing money in for 2023 right now. Still, they're kind of hit up against the deadline here. You can go ahead and still put that money in. It is $7,000 for 2024. Now you get an extra $1,000 if you're age 50 or older. So basically the incentive there is for those in their 50s that need to catch up, that haven't been as good about putting money in, they let them throw in an extra $1,000. I know it's not going to make a huge difference, but it's worth taking advantage of if you're in that scenario. So that would be $7,500 for your 2023 contribution, $8,000 for your 2024 contribution for any of you that are age 50 or older. Okay, Linda Riley asked, I already have a Roth IRA. Is it possible to convert it? Also, are you allowed more than one Roth IRA? I am over the income limits. Am I still eligible to do a backdoor IRA even if I already have a Roth? Okay, a lot of questions in there. Are you allowed to have more than one Roth IRA? Absolutely, yes. You could have a Roth IRA at TD Ameritrade, buying and selling your stocks. You could have a Roth IRA, a directed IRA that's invested into a real estate deal or a rental property or private money lending. You could have a Roth IRA at your local credit union with a CD. I mean, you can have as many Roth IRA accounts as you want. You can only put new contributions, though, of 7K. So that's the 2024 contribution limit. You can put in 7K a year. Again, 50 or older, you can put in 8K. So even if I got 3 different accounts, I don't get 7K for each one and I can put in 21,000. No, you get 7K total. So I could put 2,500 in one, 2,500 in another, and $2,000 in another, and you could spread it out if you wanted. But it's one individual limit no matter how many accounts you have. But you can have as many Roth IRA accounts as you have. Like my largest client has a 400 million Roth IRA, like a $400 million Roth account. He has 30 to 50, I don't even remember. He's got in that range of Roth IRA accounts, okay? But you're still limited. You can only put 7K in a year, 8K if you're 50 or older. Now, you're over the income requirements. Am I still eligible to a backdoor IRA? Yes, that's what it's for. If you're over the income requirements and you're trying to get new dollars in, new money into your Roth account, that's what the backdoor Roth is for. It'll let you get in that 7,000 because you're over the income limits. You can't just drop it right into the Roth. You have to do this kind of 3-step process with the backdoor Roth IRA where you open up the traditional, you make a non-deductible contribution for your annual limit, and then you convert it over to the Roth account. That's the backdoor Roth IRA. So it takes more steps, but it gets more money in for any of you that are high income and you aren't otherwise eligible to put money into a Roth. Now, you could convert in any income limits, though. So if you're like, well, Matt, I have 100K in traditional dollars and I'm over the income limits. Well, who cares? You could just convert that. Just convert it tomorrow. I mean, you'll pay tax on the conversion, but there's no income restriction on Roth conversions. About 15 years ago, there used to be a restriction that said you can't do a Roth conversion even if you're high income. But they removed that rule. A lot of high income people converted to Roth. Congress collected a lot of tax revenue that year, and they're like, we better leave this year. So that looks like it might stay. Although, like I mentioned before, the Biden administration, in their most recent budget and policy statements, has said they want to close out the backdoor Roth IRA, and they want to close out Roth conversions for high-income individuals as well. And for that was people making over 450K a year. Now, that's not in a bill. It's not in Congress yet. That's a priority of the Biden administration. They'd have to win an election and, frankly, convince a lot of people, even Democrats on Capitol Hill, to get that out there. But that is certainly out there. That sentiment's out there. And so we want to try to get as much dollars into Roth now as we can. We want to make sure we're taking advantage of these loopholes while they're still there. All right, let's take
I got a little question that we can kind of throw in here in between it here.
All right, Tristan's got a live question. I got a couple more I got one more here I'll do too that was a pre-question, and then we'll get to any of your other questions. Any of you hanging out, hang in there. I'm going to get to all your other questions, including who's going to win the NCAA tournament. That's still going, right?
Yep. All right, you're going to like this one.
You guys do not want to know my answer on that. Obviously, I have no idea.
This one's easy. When is the next Directed IRA event? Where is it at? How can you get a ticket?
Oh, absolutely. Great question. You guys have got to come to Dallas. Okay. April 20th, go to sdirasummit.com, sdirasummit.com. There's a whole section on Roth accounts in particular. We go over Roth conversions, backdoor Roth, mega backdoor Roth. There's a section, I think we call it Roth Baby or Roth Enroll. I don't know. But we have a section dedicated specifically to the Roth accounts. And then, of course, all the other strategies you need to know on self-directing. We're going to have expert people there that have $1 million plus retirement accounts. Actually, the ones there, they're going to be Roth, going over what they've done to build it. I'm going to be explaining all the strategies and things Basically, what I'm going to do is I'm going to take my book, the Self-Directed IRA Handbook, that's like 300 plus pages and has over 100 legal citations and tax court citations. And I've condensed that down into like digestible, entertaining, easy to understand approach on how to self-direct. So it's what you need to know. We got a lot of other great speakers. So come to Dallas. It's at the Westin Galleria. It's a beautiful place. We're going to have a live rock band on Saturday night and some networking stuff. Lots of cool people. My law firm partner, many of you know, Mark J. Kohler will be there. Some other great speakers. So go to sdirasummit.com, check it out. And if you can't make it to Dallas, we still have a virtual option. You can stream it and get a recording as well. All right. Okay, let me take this last question and then let's just fire away at any questions anybody's got live on any topic, within the wealth building format. That's outside of that, what Matt knows is pretty useless. Let's be honest. There's definitely confirmation in the room here. Okay. With the new, this is from Osito 852. With the new Secure 2.0, can I start to max out my Roth SEP IRA and still do a backdoor Roth? Prior years had nothing in any type of IRA. Specifically worried about line item number 6 on Form 8606. Okay, this must be a CPA asking this, and that's okay. Secure 2.0 allowed for a new thing called a Roth SEP IRA. The IRS does not have the forms out for that. We've been waiting for it. We want to offer a directed IRA, and we will. SEP IRAs traditionally had to be traditional dollars. You got a tax deduction. It grew and you didn't pay tax, but when you pulled it out of retirement, you paid tax on the way out. So that was what everybody knew a SEP IRA was, traditional dollars at the end of the day. But under Secure 2.0 that passed over a year ago, the IRS still doesn't have model forms out for this. You can now do a Roth SEP IRA where you don't take a deduction, but now the money's growing and coming out totally tax-free. So that's around the corner. The question is, can you still do the backdoor Roth? Now, I haven't read the code specifically on this or the 8606 instructions on this. My sense is yes, because those are Roth dollars. It's Roth IRA dollars at the end of the day. And so my guess is the 8606 probably says, have you converted SEP dollars? And it's thinking of SEP in the traditional sense of traditional IRA dollars. My guess is yes, you'll be able to, and I'm 90% certain on that you'll be able to get away with it. Now, what I would say, and this is what we tell all clients, just do a solo K. Why are you doing a SEP IRA? We like the solo K better. You could put $69,000 in the solo K. You could do 69 in a SEP IRA, but it's easier to get the money in a solo K faster on lower income than it is a SEP IRA. In a SEP IRA, you can only put in 25% of your income. Okay. To max out at 69K, let's do a little handy calculator. So if I want to get 69,000 in there, let's divide that by 0.25. I've got to make $276,000 to max out. The SEP IRA, whether you're doing Roth or traditional dollars. In a solo K, on the other hand, I get to put 23K in immediately of Roth dollars if I make 23K. So now I've only got to do 25% of 46,000, which would be, 46,000. Okay, so now I need to make 184,000. So to max out a solo K to get 69K in, you need to make 184 grand. Oh no, that's too much. Sorry. Let me do. Yeah, that's right. 184 grand. So that's 46,000 of matching. That's the 25% of your employer contribution. And that's your 23. If you're not following this, that's okay. We have another video on solo Ks, how you make contributions, the rules and everything. But just to answer that specific question, that's what I would do. I would use the solo K because you get there faster on less income. Okay, let's take some questions from those that are here live.
Yeah, we're going to go general questions now.
All right.
This one is from Voight. He said, what happens if you over contribute to a Roth IRA? How do you calculate how much to remove?
Okay, if you over contribute to a Roth IRA, let's say your income limits are too high, and we're doing this every year. We're doing some right now and fixing them. You have a couple options. The first option is the easiest, and you just say, 2023 was an anomaly. Let's say my income limits were too high and I did a regular Roth IRA contribution. What you can just do is say, let's just count this as a 2024 contribution because I don't think my income is going to be as high. Now, if you're like, 2024 is going to be the same, because the IRS allows you to change the election year, the contribution year, if you're in this scenario. That's the easiest option. That's option one. If you're like, no, 2024 is going to be even better, I'm going to have the same problem. I can't just change the year. The next option is you have to recharacterize it essentially as a traditional contribution, which is non-deductible, and then you do the backdoor Roth IRA. So we fix a lot of these by doing a backdoor Roth IRA. Now, if you've invested, it's kind of messy. If you have investment returns and everything, it's kind of messy. But if you have an account at Directed IRA, we do these every year. There's always a handful of clients that need this fixed. So it is possible to open the traditional, move it over, book it as non-deductible, and then convert it over to Roth. And that way, at the end of the day, you still get the money back in the Roth. Now, that takes some gymnastics. You're going to have some paperwork. You're going to have to move money around. It's going to suck. Don't hate us. Don't hate your IRA custodian, whoever you're using. Hate the game, okay? We're just trying to help you fix it. And so it will take some gymnastics to fix, though. The last option is you just pull it out. Since you didn't take a deduction on it, there's no tax, but you do have a excise tax. I don't know if they call it that, but there's a tax on any gains that you might have had in that account where you do have to pay tax on that and a penalty. So, so that's your three options. Change the year, try to fix it doing a backdoor Roth, or take it out and pay a penalty on any gains.
Matt, do you know of any changes coming to solo 401ks in 24 or 25?
Any changes to solo Ks in 2024, 25? Nothing groundbreaking. I mean, the contribution limits always go up because they're adjusted for inflation. So those will go up. We have inflation. I know, shocker, but we do have it. So, I'm not aware of anything specifically changing for solo Ks. Nope. I mean, there's proposed legislation out there, but there's nothing I'm aware of in terms of like that's in the law right now.
Okay. Got a little bit of a basic question here for you. How do you know when you maxed out your 401k?
Ooh, how do you know when you maxed out your 401k? So a couple ways. The first is, well, let me say for if you have your own business or you have a solo K, the max you can do is 69,000. 69,000 is the max. If you've put in 69,000, you've maxed out. Now, if you have a 401k at a place where you work, okay, you're employed somewhere and you have a 401k. If you're under age 50, the max you can put in is 23,000. Okay, so I can put in 23,000 as an employee. That's the max I can put in as an employee. If I'm 50 or older, you get another 7,000 that you can put in as an employee. All right, so you're up to 30. It might be 7,500. Let's check that. 50 or older on a 401k, 7,500 or actually, let's do that. Yeah. Oh, is it 8,000? All right, you confirm that if you could. Okay, 8,000. Okay, so you can do 31,000 in a 401k. This is 2024 as an employee if you're 50 or older. Now, the company also does a match, so let's say you make 100K a year. The most common 401k match is what's called a safe harbor 401k, where the company says, we'll put in 100% of what you put in up to 3% of your salary. So if you make 100K, up to 3% of your salary would be 3,000. So if you put in 3,000, the company would put in 3,000. The next part of the safe harbor says, and we'll also put in 50% of what you put in to your account up to the next 2%. So the next 2% above the 3%, if you put that in, they'll put in 50%. So let's go back to that example. You make 100K, you put in 3,000, the company will match and put in 3,000. Then on the next 2%, you put in 2,000, they'll put in 1,000. Okay. So in the end of the day, as long as you put in 5K, 5%, you're going to get 4%. That's basically what it is in the typical safe harbor if you want to max out the free company match that goes in. Now, you can still put in, on top of that example, if you put in 5K, you could still put in another 18,000 of employee contributions. You don't get any match. The company's not throwing any more money in, but you're getting new contributions in. A lot of people feel like that's when they've maxed out because they've already maxed out the match. They've put in as much as they can as an employee. The only way past that would be what's called an after-tax contribution in your 401k, which you'd only do if you're doing the mega backdoor Roth, which is something you could do. But you want to get definitely your CPA or accountant involved in that scenario. The backdoor Roth's a lot easier to pull off, I have to admit. If you want to do a mega backdoor Roth 401k, far more complicated. But it is possible to do. So, but for most people, maxing out a 401k means I put in my 23K and I got as much of the match as I could from my employer. I'm going backdoor Roth IRA next.
Great. Okay. I have a bit of this is one of the last few questions that we got online, but it's a little complicated. I'm going to try to reword it and see if you can get this one for me here. So Kona wants to know, he has multiple accounts. So he has He has a traditional 401k that is with his W-2 that he gets a match from.
Yep.
He has a Roth 401k. He's making 80K at his W-2 job with a 6% match, and then his side hustle is making 100K. He has an IUL for his daughter, that traditional account, and the Roth account. He wants to know how he can maximize his contributions best.
He has an IUL for his daughter, and
Yes.
then what about a Roth account?
And he has the traditional 401k and the Roth 401k. He wants to maximize his contributions, but how should he prioritize that?
Okay. All right. Okay, great question. So you have the day job with the traditional 401k. Our rule of thumb is always go get the free match. So if you have a 401k at an employer, the one great benefit of a 401k at an employer is they do a match. Most companies incentivize you to save in the 401k and they throw free money at you. So if they're going to do a match up to 6%, I think is what I heard, put in 6% of 80K, so what is 6% of 80K, but put in 6% of 80K into that company 401k. Now the downside on the company 401k is you have limited investment options, right? The company 401k probably lets you invest in some target date fund or a mutual fund. That's fine. It's better than anything. It's better than it just sitting in cash. It's going to grow. But the nice thing about participating in the company 401k is you got 100% match on that 6% in day one. Like you doubled your money if they're doing this match on dollar for dollar. Now, if they're only doing 50%, like the safe harbor I mentioned on the next 2%, it's a little blended, but it's a huge return. Obviously a big incentive. Go pick up that free money from your company. After that, so let me just do the math here for you, because 6% of 80,000 is, was it 4,800? Okay, 4,800 bucks. So you put in 4,800 into your company 401k, your day job, they go and put in another 4,800. After that, you make another 100K in your side hustle, and you could do what's called a solo 401k. So if you have a solo 401k, and this is anyone that has a side hustle or self-employed with no other employees, you can have your own 401k plan. It's called a solo 401k, where you can put up $69,000 a year. Like you could put up $69,000 into a solo 401k. You could do Roth or traditional dollars. You get to pick, or mix and match it if you like. Now, the cool thing about the solo K is you have better investment options. You're not just limited to a target date fund and a mutual fund like you are at your day job 401k. In the solo 401k, I can self-direct it. I could do a real estate investment. I can invest in a small business. I could do private money lending. I could invest in a private equity fund. I could invest in precious metals, or I could buy crypto, Bitcoin, whatever you want to do. All those assets are available as an investment in a solo 401k. Whereas your corporate 401k, your day job is going to say Wall Street, target date fund, mutual fund. That's all you get. So the solo K has way better investment options. That's why we like to put more contributions over there. Now, here's how much you could put into the solo K. At 100K income, because you make 23K, you can put in 23K. Now you got to do minus the 4,800 you already put in as an employee contribution in the day job 401k. So now we are at, let's see, 18,200 you could put into the solo K as an employee contribution. Plus you get to do 25% of 100K, which is 25K plus 18.2 is 43,200. Okay, here's just, I was doing the math there. Hopefully some of you are following if you know the calculations, but when you have a day job 401k and you make employee contributions, in this example, $4,800, and then you go do a solo 401k and you're like, well, I want to max out there too. Well, we have to reduce your employee contributions by what you put in your day job as an employee contribution only. So in that example, we put in 4,800 bucks. So I got to subtract that from the 23,000 I can put into my solo K on the employee contribution side. Now, the employer contribution side, or the match, there's no restriction. You don't have to subtract what the company put in at your day job 401k from what you're going to put in company contribution or match on your solo K. No restriction. You don't have to reduce it. But the employee, it's 23K across all 401k plans, period. So, but you still had 18,200 left. And then of course, 25% of 100,000, that's the maximum match you can do on a solo K, which would be 25,000 bucks. So You got $43,200 there. Now you can also do a backdoor Roth IRA, by the way. On top of this, we can go throw $6,500 in for 2023, $7,000 into 2024. Now I've got a backdoor Roth IRA of $13,500 as well, because I'm taking 2 years of contributions there. So, and that's how, frankly, a lot of successful clients that have large numbers in their retirement accounts do it, is they're using all of these buckets that are available to them. They're not just taking the easy layup and doing the company 401k and getting their match and being done. Like, all right, what do I do next? Okay, I'm going to max out my employee contribution. Oh, I'm going to go do a backdoor Roth IRA. Oh, I have a side hustle business. I can do a solo 401k, or maybe my spouse does. I can get more money in. I mean, that's how they're building this long-term tax-free wealth using Roth accounts in particular. And then we throw in the backdoor Roth IRA. You could do kids Roth IRAs too. If you have a small business and your kids work in the business, we can do Roth IRAs for them. If you got a spouse, whether they're working in your business or not, or your spouse should be doubling up and maximizing their contributions as well. If you have a spouse. So that's how you build these large retirement accounts, is utilizing every contribution to get the money in. And I think for people who are new to retirement accounts, it's very frustrating your first year, second year, third year, because it doesn't seem like that much money. But once you've been doing it for 5 to 10 years, you're like, wow, these are 6-figure accounts now. And then you're doing it for 20, 30 years, you're like, this is a 7-figure account. And because it adds up and it compounds, your money starts working for you. But you've got to get the ball rolling. You've got to get money in. The client I mentioned has a 400 million Roth IRA. I have another couple clients that have 100 million plus Roth IRAs. A lot of clients at the 10 million plus Roth IRAs. They all started at zero. We all start at zero. So don't feel frustrated. Everyone was there. You've got to start getting the money in, contributing, maximizing it, getting the money in. If you have to do the backdoor Roth IRA to get the money in because you make too much money, do the backdoor Roth IRA. It's there. It's available. Take advantage of the loophole. All right, we got any other live questions?
I kind of got one.
Yeah.
What would be the benefits of going with a kid's Roth over an IUL for his daughter?
Okay, benefits of a kid's Roth over an IUL. Okay, the big difference between a Roth account and an IUL is the Roth account is a vehicle that you can invest into anything. In a Roth account, I can put the $7,000 in. I can invest it in whatever I want. The money grows and comes out totally tax-free. And every year I can put in my $7,000 contribution. And this you do for a kid's account or your own account. Now the kid would have to have earned income in order to do it for the kid's account. An IUL, on the other hand, is an insurance product. And there's a lot of people who promote the IUL, but the big difference and the big issue I don't like about IULs and why I don't recommend them typically for clients, there are some fits where it can work, is you don't have an investment option that's unlimited. You're betting on a life insurance company to go invest the money and take it back out. Sure, I can loan myself money from the life insurance policy and I can go use that money to go make money, but I'm paying tax on that. I already had that money. What did I need to give it to an insurance company? And so the IULs, and there's lots of versions of these different types of policies. I don't mean to generalize the IUL here, but these cash balance policies that you pull loans out of, we just have not seen I just have not seen it being a game changer. And I'm just telling you, as a business and tax lawyer, someone that's helped plan a lot of wealthy people's estate plans, where they come into us at 50, 60 years old, and they've got tens of millions of dollars, and they're thinking, how do we give this to our kids? How do we recognize the charities? They don't have IULs. They do not have them. There's all these people that say, oh, the rich people have them. Not the ones I've ever talked to. And I get a full disclosure of everything they have. Where is their wealth built? It's in their retirement accounts. There's $35 trillion in U.S. retirement accounts. It's in their real estate, whether this is rental real estate, or their own residence, or commercial properties for their businesses. And it's in business ownership. That's where the wealth is. It's those 3 buckets. It's not in insurance policies. Now, again, there could be a strategy for it. Not my expertise. I'm just saying I don't see it. I just don't see it as a common strategy for people who really have built real wealth.
All right. I don't know.
Oh, we got all the live questions?
Yeah, we got
a
one.
few minutes left.
Yeah, you might want to, you're going to beat up on another plan again here. Question for you. All of my income is in healthcare via 1099. How much do I need to generate to consider starting a defined benefit plan as opposed to maxing out a self-directed IRA?
Ooh, okay, great question. There's something called the defined benefit plan, or DB plan. This is essentially a pension plan that allows you to put way more money in. Now, the one thing on a DB plan, and there's lots of versions of this, cash balance plan would be the most popular one we'd see clients use, is it's all traditional dollars. So if you want Roth dollars that grow and come out tax-free, you could do a combo scenario where maybe you do a Roth solo K and get some Roth dollars in a solo K because you're R1099, you're self-employed, you could do a solo K. Let's get some Roth dollars in there. You could do the backdoor Roth IRA on top of it, get 7K in there, and then go do the DB plan. A defined benefit plan is something that you can put up to $300,000 a year into it. Like you could put over $300,000 a year into defined benefit plan and take a $300,000 tax deduction. Now there's perfect candidates for this. Frankly, this person asking the question is the perfect candidate. Self-employed, no employees, getting 1099'd, in healthcare, high income. That's the perfect person for it. I looked at doing, Mark and I, in my law firm, we looked at doing a DB plan. The problem with it for a lot of business owners is you have to do it for all your employees too. So if you want to be throwing in hundreds of thousands of dollars every year, your employees are going to get some really huge retirement account contributions, and the math just never works out. All the savings you're trying to get, you're going to be losing by having to match and give this pension plan essentially to all your employees. But if you're self-employed with no employees, it's a really awesome fit because you don't have to worry about that. It's just all about you and how much you want to get in to the DB plan or defined benefit plan. Now, there's a number of advisors we work with that help clients get these set up. A defined benefit plan is going to cost you $10K plus to set up. They're not cheap, so you're going to need to spend some money to get those set up. And then also the defined benefit plan is can be self-directed though. We have a lot of client accounts at Directed Trust Companies, Directed IRA, that are their DB plan that is actually self-directed, investing in real estate or private companies. You don't just have to do a DB plan and be investing in the stock market, buying stocks or target date funds or mutual funds or index funds. You can self-direct a DB plan. We just use what's called a custodial account at Directed. And then you typically have a provider of your DB plan that does your annual tax return, because a DB plan has to have its own tax return. So there's a little more work on it. But I love DB plans. We should probably do some more content on that and who's a good use case for them. It's not for everyone. A lot of small business owners it's not good for. It's not good for me. Even I got 100 plus employees. But it is great for certain people, self-employed people, very high income. You want to do more than you can in a solo case. 69,000 isn't enough. You want to do more than that. The DB plan is a good option. It's also a good option for there's a lot of doctors and dentists that do this where they're older, they're maybe in their 50s, and their employees are a lot younger. And so in a pension plan or a DB plan, there's also ways where you can really supercharge your own contributions without having to give too much to your employees. I hate to say it that way, but that's the reality of it. Because that's the hang up when people do the DB plans is it's a pension plan. It has to be available to all employees, and all this generous stuff you want to do for yourself, you got to do it for the employees, but you can overweight it to older people to put more in for them than younger people. So we do see a lot of physicians and higher income business owners that are older than their staff where they're still doing a DB plan.
That question came from a fellow Matt, and he actually followed up and said that he's been working with Darren and has another meeting coming up soon.
Okay, great. All right. Yeah. Darren's super smart. He's gotten really up to speed on a lot of this stuff. So
last question. Any way of contributing more than the contribution limit of 16K to a simple IRA? If I convert them immediately to my Roth, or is the 16K the max limit?
No way. There's not a way to do it. Even if you convert it to Roth, it still counts as your annual contribution. So no way to double that up. I mean, I guess you could do the backdoor Roth after you converted the simple contribution to Roth. You could then do the 6,500 backdoor Roth for 2023 and 7,000 for 2024. That would be an option. But that's about it. I mean, if you had a side hustle, I don't know if this person owns a business and is doing a simple IRA for themselves and their employees. But you could consider doing a solo 401k. If you're an employee in that business has a simple IRA, maybe do a solo K on your side business. I don't know. It depends on your situation.
Okay. I know I said last question, but I did get one more from Kona and he wanted to follow up.
Okay.
He said this one's for his mom. She runs a 501c3 here in Hawaii for the past 20 years. How can I recommend her save for retirement?
501c3. Well, I mean, a nonprofit can have a 401k, or sometimes they'll be do what's called a 403B, where the nonprofit is putting money in to the employee's retirement account. So that's possible. If she runs the nonprofit, she could create the 401k. The other option is, of course, the IRAs. I mean, she's probably older here, as would be my guess. So, we could be doing the Roth IRA. I don't know her income. Is she over the 146,000 single, 230K married? If she's not, she works for a nonprofit. She's probably not. She could just be dropping the 7K directly into the Roth IRA, which, remember, could be 6,500 for last year and 7K this year. One danger I see, though, for a lot of people, and I hate to say it, it's a lot of people in their 40s and 50s who don't have money in a retirement account, is they get stuck because they're wanting something they can put 100K in. And then I'm like, okay, do you have 100K to put into it? They're like, no. Why are we talking about this then? If your budget allows you to put in 7K, let's do that first and then think what we can do next. So I think for your mom, what I would do is just look at me doing $6,500 in a Roth IRA for 2023, 7K for 2024. She could do an extra 1,000 on both those years if she's 50 or older. And so, that could be $15,500 right there. And hopefully she has that cash on hand and can throw it in. Then she can be doing 7K or 8K again next year as well. Then think of what you can do on top of that. What you'll do on top of that is going to take more work, because that might be a solo K if she has a side business. That could be setting up a 403B or 401K for nonprofits up, which is possible. A little more costly and a little more work. I think those would be the options for her. All right. Well, thanks everybody for tuning in. This does get edited a little bit, and then we post it up on YouTube. Make sure you're subscribed to the YouTube channel. Make sure you're also subscribed and signed up for our private Facebook group. That's Team Wealth Building with Matt Sorensen. You'll be getting notification of what's coming up. We'll probably be more specific private group content up in that Facebook group as well. And then you also get notifications of what we're coming up with live. We're going to send out surveys to see what topics we want to have covered in these lives. A couple of things to know for next week's live is we might do the mega backdoor Roth. I'm probably actually send a survey out. We might do the mega backdoor Roth. We might want to talk about what realtors are going to need to know. There's the new settlement for the Realtors Association, how you as a home buyer, investor, or realtor are going to need to interact now in the marketplace when buying and selling real estate. The rules have totally changed given the settlement that the National Realtors Association has. As many as you know, they lost their antitrust case. So there's a lot of cool topics I want to talk about, but we'll see. We want to get a survey out there, what you guys want to hear, because that's what I'm here. I'm here for you to just help answer your questions. We'll be back next week with another live. Till then, stay calm, self-direct on.